here's the bid. So you can see that for at least the most recent trades, what's been going on? Well, the market looks like it's trending down, doesn't it? But this, you have to remember, these are just very few trades. This is what's called a tick-by-tick chart, so they're measuring the actual trades. That's not really what we're interested in. It just looks neat, and I wanted to explain it to you. Over here, we can see the price. Right now, we have 9598 by 9603. Now, the good thing about the trade navigator here with Interbank FX is if we want to buy, all we have to do is click on buy. They don't make it very complicated. If we want to sell, we just click on sell. Now, I want to talk about this function right here. Now, you remember we've been talking about trend continuation trades. So let's say the market's trading here. You've got an upsloping and then a downsloping, but we've got a very aggressive downtrend. So the market's trading up here, and then it's getting near to support. So we're looking to trade on a breakout. Well, sometimes the market might break out and move very quickly. This maximum deviation from quoted price is a very, very convenient function here. Okay, let's use this price right here. We're looking to sell pounds. Remember, the market's going down, so we want to sell as it goes down. So if we enter an order to sell at 95.96, if the market's moving too fast, our broker might fill us much lower than that. They may fill us down at, let's say, 95.90. So you can see there's a 6 pip difference. Well, if we don't want to pay, 95.90. If we don't want to pay 95.90, this is where we enter what they call the maximum deviation. What they're asking you is, how far are you willing to let us move from your price? Very, very nice function. This way, if we're trying to sell 9603 and the market starts moving, if the market moves down, let's say it moves down very aggressively, and all of a sudden it's down at 95.90. If we don't set this, then our broker is simply going to fill us here. You can see we've already missed out on 13 pips. So instead of having to risk this, we can simply tell our broker, hey, if you can't get me my order within 1, 2, 3, 4, 5, 10, within, let's say, 2 pips, then I don't want to get in at all. So that would be your maximum deviation. So in that case, if we were selling at 1.9603, the lowest that we could take an order would be 9601. If it went below there and they couldn't get us our pounds sold, then we simply wouldn't get filled at all. They'd come back and tell you, well, we couldn't get your order in time. The market was moving too fast. Okay? Now they have the order type here as well, what they call instant execution. Instant execution means it's going to happen right now. This is also called a market order. Now, a market order simply means I want to sell at whatever the market price is right now. And that's why they have this maximum deviation. Because if you think about it, the market right now, if we want to sell, is 9605. Well, what happens if the market starts going down? Well, the market could easily change to 9602,